You've probably heard it 1,000 times. As soon as you buy an option, time is against you. And in order to make money after buying that option, you don't have a lot of time for your directional bet to work, whether it's calls or puts. So in this video, I'm going to show you how to eliminate time decay the next time you want to buy options for a directional bet. So let's take a look at the SPY real quick, and let's just pretend for a minute that we are bullish on the SPY because we're in an uptrend and we're having a pullback, but ultimately we think this thing's going to go higher over the next few weeks. So one thing that a trader might consider is buying a call option. The problem with buying the call option is that time is against you when you buy a single call option, and we don't really know exactly how long it'll take for the market to go higher. So even though I have a bullish thesis for this particular example, it doesn't really mean that I know exactly when that's going to happen. And the longer it takes for my bullish thesis to play out, the more I can lose money with buying a single option. So let's go ahead and look at the option chain and let's see what we see here. So I'm looking at the SPY options, and you can see that I'm going to just kind of look at the front month options, and we're looking at all the strikes pretty much around the 234. We're trading at 233.86. But what you'll notice that no matter where you go, whether it's in the money or out of the money, the theta column has a negative value. And you can actually see, even though you go deeper in the money, you'll still pay $6 a day for this particular option. So let's just say, let's look at the 232, for example. If I buy the 232 call option because I think the market's going to go higher, I'm going to pay $430 $440 for it, and I'm going to start losing $6 a day as I wait for the market to, follow my whatever my thesis is. In this case, it's the market going higher. So what I want to sort of explain that you can eliminate this by simply selling a call option against your option, basically making a call debit spread. And by doing that, we can eliminate the time option and give ourselves time to let our bullish thesis play out. So let's go ahead and do that and see what that looks like in the chain. I'm going to change this to a deep and wide 4-strike vertical just to give us some whole number strikes. I don't play these half strikes very much, but you can see now that in the theta column for any one of these particular call debit spreads, and now we're talking about vertical spreads, that there is no time decay or very, very little. So we've eliminated a lot of them. Now there's still $1 here for this particular straight spread, but you can see that we've basically eliminated time decay so that we can have time for our bullish thesis to play out. Now, for any one of these spreads, as long as you're in the money, the spread is going to be worth $2 because that's the width of the strikes. And so at this point, you can start looking at probabilities and how bullish you are, but we'll save that for another video. So by turning your single call option into a vertical spread or a call debit spread, you are essentially able to eliminate theta to give yourself more time for your directional thesis to play out. In this case, it was a call option because we were bullish, but it's the same on the put side. So if you haven't done so already, be sure to like this video and subscribe to this channel for more vertical spread awesomeness. My name is Eric, and I'll talk to you soon.